This is The Bottom Line, a show designed to help Australian businesses succeed. On the show, you'll hear from leading Australian business owners as they share the lessons they've learned building their companies. You'll learn from their successes as well as some of the challenges they faced along the way. We also talk to experts from a range of fields who share specialised techniques you can use to improve your business. I'm your host, Savan Tuna, and I'm a director at Alexander Spencer, and I'm really passionate about helping Australian businesses succeed. Business owners are busy, employees are working longer hours than ever, and sometimes we just don't have the time to look after our own financial health. And this is where the financial planning industry comes into play. Today I've got David Posterino from AS Wealth Advisory. He joins us to discuss all things to do with insurance, financial well-being around your money in your bank account, and he gives us some tips on making sure that you get the best out of your wealth and your wealth creation. Everything that David has talked about today is general advice. If you're thinking about acting on any of the advice today, make sure you go and seek your own personal financial advice before proceeding. All right, let's get into it. David, my man, how are you today?
I'm very well, thank you.
I'm very excited to have you on the show.
Thank you. Very excited to be here as well.
For those that don't know, the Italian stallion, David, tell us about yourself. People that probably haven't heard of you before, you're new to our group. Let's dive deep into David Posterino.
Originally from Geelong, grew up in Geelong all my life, moved to Melbourne back in 2014, so came up. So probably just a bit of a background from the work side of things. So initially out of uni, finished uni, did a commerce degree, accounting, finance, financial planning major. At the time, wanted to be a financial advisor. We went through in 2007 the global financial crisis. And while I was at uni, I wanted to always do financial planning. My mentor at the time told me, well, to be a financial advisor, you need to do a degree in commerce with a financial planning major. Did all that, absolutely hated accounting while we did it. And then, finished uni, tried to get a job in financial planning. The whole market crashed, global financial crisis, and I couldn't get a job. Had a job lined up with AMP at the time to do a graduate position. And before I started, I got fired. So from there, I just started looking for jobs, applied for a job in accounting, and I got it. So then unknowingly for 7 years, I was an accountant in business advisory. So made the move back to Melbourne in 2014. And that was all off the back of trying to get out of accounting at the time. I thought my personality probably wasn't one to just sit behind a computer doing things as such. So I wanted to get into something a little bit more sales. And the financial planning side of things was something that I was quite interested in. So
there you go. So let's talk about GFC. Now, you're from Geelong. It can stand for a few things there, GFC. Yeah. So you're a Geelong fan, Geelong Football Club?
Geelong Football Club fan. Was part of the cheer squad all my life. So I'll tell you a little bit of a story about that. Back when I was younger, and I'm talking 8, 9 years old, we used to go to Cardinia Park. And back then, everything was standing. So one day we went there. My grandfather used to take us to the football. It was raining one day, wanted to get us a seat. We were sitting behind the cheer squad. My grandfather went up and goes, how much does it cost to get a seat here? And they said, well, you have to be a member of the cheer squad. Back then it was $20. So he signed up myself and my brothers as part of the cheer squad. So we did that every single year for about 6 years. I've still got at home the sign of Gary Ablett kicking 1,000 goals. So,
oh, wow. Were you in the cheer squad when that happened?
We were in the cheer squad when that happened. The reason we got out is because we had to start cheering.
Well, let's get back into it. So you did accounting for 7 years. GFC also stood for the global financial crisis. So you're trying to get a financial planning or a wealth job around that time that called. But you stayed in accounting for 7 years. For someone that didn't like it, you stayed the course. Tell us the journey when you finally thought this is not going to be for me.
So I think I stayed in accounting for so long was because I was actually engaged the whole time that I was doing it. And my mentor at the time used to always say to me, if you want to be a good financial advisor, do accounting first because it sets the foundations to be a good financial advisor. You're young at the time. You're like, when you're looking at it then, you're like, financial advisors make good money. Accountants aren't so much unless you're a director. So I wanted to get straight into it. But now that I look back, I would probably say to any financial advisor, if you want to be good at what you do, you need to have an accounting foundation, because the accounting foundation gives you an understanding of taxes, structures, things that you probably wouldn't know as a typical financial advisor just going in as in a sales role. So I was engaged for 7 years, and the only reason why I got out, because I thought to myself at the time, I know everything I really need to know, the fundamentals. Now it's time to move on to something that I really enjoy.
Yeah, and 7 years is probably about the right time, 5 to 7 years. You either had to proceed with that career and go all the way if that was your call, or find another avenue. But let's talk about your expertise today, which is wealth management. For those people that don't know, what is financial advisory, financial planning, wealth management? There's a few little terminologies there around how we define the industry that you work within. Tell the listeners that don't know what you do, what you actually do.
I would probably say financial planning is really what we're doing is understanding a client's goals and objectives and putting something in place, because typically what somebody will do is they've got an idea of what they want to get to, but there's a little few things that happen in the wayside that stop them from getting to their goals. I'll probably even give you an example as a personal trainer and somebody in fitness. You've got a goal, what you want to do, but things happen during the day or your food habits change that you don't actually stick to a plan. What a financial advisor does is for money, is that we put a plan in place and help a client achieve the goals that they're trying to achieve.
And talk about some of those levers that you have access to. So is it just putting together a plan and just you don't putting it in the top of the drawer? We're deeper into the work.
Yeah. So what we usually do typically is we'll meet a client and understand their financial position. So we'll understand their income, their expenses, their assets and liabilities, and we will kind of guide them, educate them into what we think is the best thing for them. From there, we'll go away, evaluate their situation, then catch up with them again and give them an understanding on what we think would be a good way for them to maximise their wealth position, minimise tax, etc. From that, so we could be looking at anything in regards to investments, superannuation, anything typically that would help them create some wealth.
And do you actually then take their money, not necessarily take it and spend it on Geelong membership, but you obviously have access to their funds. So what do? You then decide, once the plan's put together, put it into the stock market. What are some of those levers that the planners utilize to help the goals be achieved?
So what we'd really understand first is their risk profile and their attitude to risk. From there, we would put together a portfolio of shares. It could be, depending what their asset allocation is, it could be shares, it could be fixed interest, it could be property. We put together a portfolio that will assist them in achieving their goals.
So we're talking about some of the services that you provide, David, but we didn't get to where you've worked and where you are now. So you are the director of AS Wealth Advisory. So as being part of Alexander Spencer, and you're our new addition to the group. We're excited to have you, but you've had a journey prior to that. So maybe take us through your financial planning professional journey with the businesses that you've worked with.
Yep.
And then we can get to some of the fun stuff you've done with clients.
So as I said before, moving from accounting, got into financial planning, got a job with Premium Banking in Westpac in 2014. That was a difficult time too, because what was happening at the time is the Royal Commission was about to happen. So I went from GFC into accounting. Then I thought to myself, and I'll probably give you the understanding, the reason why I wanted to get into financial planning at the time as well is because when you look at accounting, a lot of decisions that you can make as an accountant is to your discretion. There's no black and white in regards to taxes. You want to put through a deduction, it's depending on what you think is right and what's wrong. At the time, financial planning was just straightforward. Taxes are zero if you're in pension, tax is 15% if you're in accumulation. There's no, to your discretion on what an expense should be, if you can claim something or not. So I got into financial planning, first time in a sales role as well. So I was really looking forward to it. But then we had the Royal Commission. So then the rules around financial planning had just done a backflip. So it was very hard to do work. And being in a bank at the time, the bank were very, very, when it came to rules and regulations, the red tape was huge. So I learnt in the bank, and I would probably say learning from the bank as well at that time gave me the ability to set a high standard for clients and making sure that we're doing everything in the right way. The one thing I didn't like about that, though, was that when you're working with a bank, guess what? They try to get you to push their products. So when I realized also having an entrepreneurial background, I didn't really want to work for somebody else. But what really persuaded me to start my own business was that I had a few clients that weren't part of the bank, and I tried to offer them something that wasn't a bank product. And I pretty much had to write a thesis at the time to explain why I wanted to use a product that wasn't the bank's product. So when you're looking at giving holistic advice and saying to a client, this is what we think you should do, but we're going to pigeonhole you into a bank product, I don't think that was the right thing to do. So I had two friends at the time that were at the bank, had started their own business, and they said to me at the time, well, if you want to start your own business, how about you come along with us? We'll set up an agreement and you can go out and you can write business and we'll cover the expenses. So at the time that worked out well for me because I didn't have any leads or any income. So we kept the expenses low. That was in 2017 and was pretty much working as a contractor for a firm at the time, and I came in as a partner. And I would probably explain the first 2 years were good. You started selling products to your family and friends because you believed in it now. But after a while, those leads, they dry up. So I remember speaking to an accountant when I was younger, and he said, if you can get past 18 months running your own business, you can really be successful. And, when you start your own business, you see good income coming in, you think to yourself, that's not true. That's not true. But I actually really saw that after 18 months when I had sold to family and friends because I believed in it, but those leads dried up. And then fortunately for me, it's funny how the world works. I met a good friend now who was running an accounting business who I started doing some work with. He was an accountant, his wife was a lawyer, and I started working from their business 1 day a week, and that's where some lead generations came from.
Let's talk about some of the success stories. So tell us about a story or a client that probably maybe came to see you, might have been maybe had some bad service or previous decisions that they made weren't necessarily great, and you were able to weave your magic and get them a great result. Can you sort of think of one that you can share with our listeners that can sort of articulate a journey that you've taken a client through?
I'll give you an example, and I won't just give you an example of the journey. I'll give you an example as how a financial plan can change year on year to suit a client. Now, unfortunately, this is probably a bad story, but with a good outcome. So the friend that I was just talking about, he had referred his sister to me. He said to me, my sister needs financial advice, husband and wife, they just work an income. She wants to buy a property. Can you catch up with her and have a review of their current situation? So the initial plan that we did was a review of their financial position and to assist them with a deposit to buy a rental property at the time. While I delved into the client, I've realised that, well, you've got a young family, you don't have any insurances, and they wanted to review their superannuation as well. So the first plan that we did was a review of your superannuation, a review of your insurances, and let's understand your cash flow for the first year to see if you can afford to buy a property in year 2. We catch up with a client every 12 months. By law, we need to catch up with a client on the retail side to make sure that they are getting serviced. And this is all part of what happened within the Royal Commission. 2 weeks before this client's review, the husband calls me up. Our insurance premiums have gone up 30%. I want to cancel this policy. We can't afford this.
And when you say insurance policies, you're not talking about their home insurance, right?
No, we're talking about life insurance. So life, total permanent disability, trauma, income protection. They all work differently, but when you're looking at them as a whole, what we use insurances for, and it is very boring, but insurances are there as a netting, okay? You've got a plan in place. If something happens, these insurances should be there to still make sure that this plan can continue for however long you wanted this plan to go for. So I say to the client, well, we're catching up for your review in 2 weeks. Let's have a chat about it. There'll be a trade-off. What insurance that you can afford and what I think is the right amount for you. Within those 2 weeks, client calls me back. Did you cancel my insurances? No. Why? I've been diagnosed with cancer.
Oh, wow. I or wife?
He had.
He had, wow.
Diagnosed with cancer. So from there, I've caught up with him at review time. We've gotten the income protection policy in place. We've started a claim on that. We've started a claim on the trauma. The trauma that we had in place was enough there to clear their home loan debt if something were to happen, okay? And the insurances, the life insurance we took out was we worked backwards. How much does this client need to live off? What's their living costs? So we worked out backwards what type of cover as a lump sum would we need to provide that income for the rest of their lives. So the second plan was now let's put a plan in place to make sure that we're covering off on the claim of the insurance and what are we going to do with the proceeds once they get paid out. 6 months in, client's wife was called at the time and told us that it's terminal. 2 young children, still at school. She's had to give up work to look after the partner. She doesn't have any insurances that she can claim on because she's not ill. So we've, at that time, done another plan. So this is all in a 3-year period, how a plan for superannuation and potentially buying a property has turned into a claim for insurance, which is now turned into a terminal illness claim to assist the wife now for an income for the rest of her life.
Can I just ask some questions for our listeners without going into the technical side? Just briefly, you said trauma paid off their home loan. Just define what a trauma policy is.
So trauma cover covers you for 41 specified medical events, but the main one will be cancer.
And it pays a lump sum if you get one of those events. And it's designed to pretty much give you a lump sum amount of money. It's not a huge amount of money because the trauma is quite expensive from my understanding. And it's designed for you to be able to maybe take time off work for about a year or two to focus on your health because you're not dead. You're in a trauma position. Is that sort of how it works?
So trauma cover, the reason why people don't like taking out trauma, because when we look at other insurances, life, total permanent disability, income protection, they all have some sort of other benefit to it. So life and total permanent disability, you can pay for it through your super. So it doesn't affect cash flow. Income protection, you can claim a tax deduction for it. So you're getting something out of it. Trauma cover, you don't get any other benefit out of it. So people don't really want to sign up to it. But it is the one that is most claimed on.
Yeah, and it can't be written in a super policy and must be paid out of your own pocket.
And it's capital in nature.
Yeah.
So it pays out a lump sum. So typically what you look at, and again, this is when we have a deep dive with a client, this is what we look into. How much do they need? So some clients might say, you know what, if I got a trauma incident, as long as I've got $200,000 there in the bank, would be fine. Some clients might say, you know what, we want to make sure that we've cleared our debt. If something happens, we don't want to have to worry about home loan repayments anymore. So it's really understanding the client and what they want to take out. But it is the one that is the most claimed on. It is the one that's the most expensive as well because 1 in 3 people will suffer a traumatic event.
My other technical question or question for our listeners that are wondering, if you're in a position where you have a terminal illness, so let's say I've got a life insurance policy, it might be $2 million. I've got a terminal cancer. Everyone said I'm going to die within the next 12 months, 24 months. Do some policies pay out the life insurance early? Because even though it's for death, does some of those companies go, you know what, I'll be nice to you and give you some of this money, all of it now, rather than wait till you die? Is there any of that?
So the client that I just used the example for is a prime example now. So he's still alive at the moment. We got paid out his life insurance. So some insurers will have a 12-month terminal illness clause. Some might have 48 months. So if a doctor has signed off and said that it's terminal, you can get your estate in place prior to their passing. Typically with superannuation, if you're holding a policy like a life policy that's held within super, the proceeds get paid to the super fund. Once the proceeds get paid from the super fund, that gets stuck in probate at the time, or it's going to get paid out based on what beneficiaries you have on the superannuation. So it can get held up in the process. So what the terminal illness clause allows you to do is to get that money out when it's signed off by a doctor, to get the money out of super and
at least maybe
set up
get
the
the
estate.
best, set up the estate, but also maybe actually benefit from some of those funds and pay off your home loan. And there might be some left over that you might do some memories with your children, that, you know, that kind of stuff. I know we're not talking the most fun things here, but
Buy
yeah,
a
it's-
caravan and go on holidays for the next 12 months. So.
I love it. Look, some of the questions you must get from your clients. What are the FAQs that a client will ask you?
What return can you get? What risk are you willing to take will be depending on what return you want to get, okay? If you're a high-risk investor, you're going to get a higher return. But in saying that too, there's going to be quite a bit of volatility in the market. You got to understand the macro side of things as well. If we typically see that the markets aren't doing too well, or they are doing well, it's got to be for a client to understand, what is my risk profile? What risk am I willing to take? But also be educated enough to understand that if you're going to get a high return, there's going to be a high risk and there's going to be quite a bit of volatility. So to answer that question is, everyone wants the highest return, but they also are the first to pick up the phone if the markets tank and say, well, what have you done here as well?
Yeah.
So I think the easiest thing to do in that situation is to understand what risk a client is willing to take, educate them into things like volatility. So then when something like that happens, it's an easy conversation to have.
So, David, any other FAQs? What are some of the other things that people ask you? Like, oh, not another one.
Insurance premiums. Every year, insurance is going to go up. The older you get, the more the premium is going to be. You got to understand how an insurance company works is everything goes into a pool, okay? As you get older, the more likely you're going to make a claim. So every year, an insurance policy will come up. So every year, you find those clients that are probably
getting itchy on cancelling them.
Or, you know, when things at the moment, expenses are going through the roof at the moment, inflation's high. What's the first thing people want to cut out? Insurance isn't a tangible object. You don't see it. The only time you see it is when you make a claim on it. The other thing for insurance as well is, this is another one probably to answer that question. When somebody calls you up asking for insurance, you know that there's probably something wrong. Because no one ever calls you asking you for insurance. Usually you need to educate them and you need to give them an understanding as to why they need it.
Yeah, I have one client that I've been trying to educate and convince to take up some policies around insurance. And he genuinely believes that the insurance companies don't pay. Can you rebut that fear where the insurance companies do not pay the actual claims if they're legitimate?
Only time an insurer won't pay a claim is if you haven't been honest from the start, okay? Because any comprehensive insurance policy we take out, it gets underwritten at the start. So what you need to disclose is your personal health information. If you have lied about that and then it gets to a point of a claim, let's just say I'm a smoker, but I put on the application I'm not a smoker, and then I get lung cancer. Then a doctor does a medical report for me and they say, yeah, well, this guy's been smoking for the last 30 years. Of course they're not going to pay out. You're lying on the application. But we typically do underwriting initially, so then when we do a claim, the process is very streamlined.
Well, let's go through investments. We talked about insurance. Investments are an interesting game. You're probably asked a crystal ball a fair chunk of the future in lots of meetings. What's your investment philosophy in general?
Okay, so it all depends on where a client is in their life cycle. To give you a good understanding, move towards more of a retirement client, okay? So what we typically try and do on an investment side is break down buckets. So we'll have a short term, your medium term, and your long term bucket. In that long term bucket is where we would hold your growth assets. So your high risk assets, your Australian shares, your international shares. In the midterm bucket, we would have things that are a little less risky, but they will give you an income generation for about 2 to 5 years. And in the short-term bucket, we usually look at things that you'll need immediately within the next 12 months, okay? So if we break down a retired client, we know that in the first 12 months, what they're going to need is pension payments. So what we usually do is we keep those pension payments in a bucket of cash where it's still giving us some sort of return. But if something goes wrong in the market, you're not going to lose money on it. The second bucket would be your 2 to 5 year bucket, something that's a little bit higher risk, but you're getting a higher return. That's something that we'd probably look at as term deposits, fixed interest, something that you're getting higher than the cash rate. And then your last bucket will be anything 10 years plus. So that bucket's giving us a high return. If something goes wrong in the next 2 years, we know we've got enough cash in the short-term bucket to ride the wave of volatility. And that bucket would also continue to add to the short-term area as well. You look at that as well, typically you're not going to see that setup. All you're going to see is your investments and what they do. But we know that that's the way it's set up. So when a client comes to us and they're worried about what's happening in the market, as long as we're in line with what risk they're looking to take, they should be fine.
Now, AS Wealth Advisors collaborates very closely with Alexander Spencer. And it's, like I said, it's great to have you in the office. You've definitely brought a lot more joy and fun to the environment here at Alexander Spencer. But talk to us how this partnership has enhanced the services that you provide to your client.
So an accountant typically is the most trusted advisor for a client. So when you're dealing with an accounting firm like Alexander Spencer, understanding over the last 5 years, and I guess since the Royal Commission, accountants used to probably give financial advice or they used to guide their clients into financial decisions. Obviously, since the Royal Commission, things have gotten a lot tighter that it's not easy for an accountant now to assist a client with financial advice. But a client doesn't understand that. So the first thing a client's going to do is ask their accountant, hey, I need advice on an investment or we're looking at retiring. What should we do? To have a financial planning in your business means that you can just call me out of my office. A client comes in, I can speak to that client. We can set up a meeting. You can handball the client. You're making sure that you're doing the right thing. You're compliant. And then we can take over and assist the client and integrate a financial planning and accounting service in one.
Yeah, well, I love it because since having you in the business, I see it in this regard. We're sort of their business consultants, their business doctors, and help them with their business side of things and help them grow their business and so on and so forth. But like you said, we're not licensed to do the personal wealth side. So I think you come in and help us close that loop and make sure the client's personal wealth is looked after. We look after their business wealth. So the collaboration is awesome. I love having you in the office. So definitely like knocking on your door to get you out of there to have meetings with my clients. But some will argue that financial advice is only for the wealthy. Do you have any sort of a rebuttal to that?
To add to that, it probably has been harder to get financial advice since the Royal Commission, because what happened from there is that it never used to be a well-known profession. It was more of a sales role. So going back to what we were talking about before, having the foundations in accounting to give financial advice is a really good way to set yourself up, because before a financial advisor was just a salesman. They would go out, they would sell insurance or they would sell superannuation, and they would get people to sign up to that.
And they weren't degree qualified in most cases. Cert 4,
Cert 3,
it's called.
Cert 4. Okay. Yeah. But what would happen back then was the product provider would pay the advisor to put them into certain products. Since then, with FASIA having to do an exam 2 years ago, what it has done is it's pushed out probably an experienced financial advisor that actually did understand what they were doing out of the industry, because they effectively didn't want to go back and do a uni degree. So financial advisors have probably halved in the last couple of years for that reason.
And therefore, sometimes it can be an expensive exercise to see someone.
It can be an expensive exercise as well, because the compliance for us has gone up. So if you understand how a business runs, if our compliance has gone up, it means that we need more staff to assist the process. So once those costs go up, so do the costs for a client as well.
Well, my last question is one that's probably come up in your little quirky FAQs that you might get from clients. Talk us about the younger generation, and maybe not just the younger generation, and the market around cryptocurrency and crypto. Is that something that you get asked a lot about? I mean, you're the money man. People have made lots of money in crypto. They've lost lots of money in crypto. What's your view on it? And are you allowed to even talk about it? Is it regulated? Let's just dive into David's view on cryptocurrency in sort of the financial advice world.
My view on cryptocurrency, I don't really understand it that well. The reason why I don't understand it well is as simple as this. We can't give advice on it. It's not regulated. So I'm not going to put time and energy into something that isn't going to assist my clients or assist me with knowledge going forward. In saying that, it comes up a lot with younger clients. But I'll tell you why it comes up a lot with younger clients.
TikTok?
Not even. Everyone wants to get rich quick.
Oh, yeah, I like that.
So I feel like the younger generation now, nobody wants to put in hard work. They want to try and find something that's going to get them rich quick without them having to do hard work. You understand, our generation, I'll probably break down the generations in a 4-step process.
Go, tell me.
The first generation build it. The second generation will grow it. The third generation maintain it. And the fourth generation spend it. And I feel like the millennials these days are probably that fourth generation that want to do things quickly and make some money quickly and don't really want to put in the hard work to get there.
I like it. David, like I said, it's amazing having you part of the broader Alexander Spencer group. We've got a bit of the bottom line journey that we're going to start together, which I'm really excited about. You're going to be a co-host and we're going to do some more conversations again in this beautiful podcast room we've got. So we're going to leverage the space, and I'm excited and for the journey of the bottom line with you on board, but more excited to have this conversation with you as a guest on the bottom line. So I want to reach out and say a big thank you for taking the time and having a little conversation with me.
Thank you. Thanks for having me.
This is The Bottom Line, a show designed to help Australian businesses succeed. This podcast was produced by accountancy firm Alexander Spencer. At Alexander Spencer, we've been helping business owners realise their goals since 1952. And we play a pivotal role in developing, implementing, and supervising the business goals and strategies of our clients. To find out how we can help your business succeed, head to our website, alexanderspencer.com.au. To make sure you don't miss an episode of The Bottom Line, be sure to subscribe to or follow the show in your podcast app. And while you're there, leave us a 5-star review. It really helps others find the show. I'm Savan Tuna, and we'll be back next episode with more tips to help you transform your business. And that's The Bottom Line.